Are you unknowingly paying more taxes than you need to on your investments? Most investors limit their tax planning to just choosing tax advantage investment vehicles like a 401k or a Roth IRA. But this barely scratches the surface of opportunities to minimize taxes. Today, I'll show you the 5 best strategies to reduce taxes in what many consider the least tax efficient vehicle, your taxable investment account. I'll walk you through an example showing you exactly how most US households can pay $0 in taxes on their taxable investments. Following these steps can boost your after-tax returns, add hundreds of thousands of dollars to your portfolio over your lifetime, and ultimately give you more freedom and flexibility. Let's first explore why minimizing taxes is so important. Tax drag, the reduction in investment returns caused by taxes, can significantly impact your wealth over time through the power of compound growth. This is especially important when investing in a taxable brokerage account. Here's a clear example. Imagine you invest $100,000 and earn an 8% average annual return over 30 years. Without tax drag, your investment would grow to $1,006,265. But with just 1% tax drag, your final balance drops to $744,335. That single percentage point in taxes costs you over $260,000 in potential wealth over those 30 years. This shows that tax efficiency isn't just about saving money today, it's about preserving your future wealth. Every dollar saved in taxes stays invested and compounds over time. As we often discuss on this channel, building wealth creates more options in life. By optimizing taxes on your investments, you're maximizing your freedom and flexibility, not just in retirement, but along your wealth building journey. While we'll focus on the numbers in this video, remember that money is a tool that gives you choices. Incorporating an intentional tax strategy can give you more freedom and flexibility. Tax optimization begins with understanding how your investments are taxed in your taxable brokerage account. Now, don't worry, I won't go too much into the weeds here. I'll share just enough context to help you understand the 5 tax minimizing strategies. Now, there are 3 main ways you get taxed in your taxable brokerage account: realizing gains, dividends, and interest. First, you pay taxes on realized gains, the profit you make when selling an investment for more than your initial purchase price, also called the basis. If you sell within a year of the purchase, you'll pay short-term capital gains rates, which match your regular income tax rate. But if you hold for more than a year, you'll qualify for the more favorable long-term capital gains rates of 0%, 15%, or 20%, depending on your taxable income. Second, you pay taxes on dividends, the payments you receive as a shareholder of a stock. Like capital gains, dividends are taxed at 2 different rates using the same tax brackets I mentioned earlier. There are 2 types of dividends, qualified and ordinary. Qualified dividends get the favorable long-term capital gains tax rates, while ordinary dividends are taxed at your regular income tax rate. So what makes a dividend qualified? 2 main requirements. You must hold the investment for a minimum period, and the dividend must come from either a US corporation or an eligible foreign corporation. Now, don't worry about tracking this yourself. Your investment broker will send you an annual tax form that clearly shows both your qualified dividends and your ordinary dividends. Lastly, the 3rd way that you pay taxes in your taxable account is on interest income, which is always taxed at your regular income tax rate. Think of this as interest on CDs, saving accounts, etc. Now that you understand how taxes work in a taxable investment account, let's explore ways to minimize the taxes. Here are 5 practical strategies to reduce your taxes in your taxable account. Think of these as guiding principles to follow when investing in your taxable brokerage account. Some of these strategies are well known and worth revisiting. A couple are less commonly discussed and might actually surprise you how much flexibility they give you in a taxable brokerage account. The simplest and most effective strategy to minimize taxes is to buy and hold investments for the long term. This means buying an investment with the intent to hold it until you absolutely need to cash it out. typically when you start withdrawing from your portfolio in retirement. Though the funds can be used as a freedom fund to support early retirement, a mini retirement, or any other popular ways to downshift before retirement. Remember those different tax rates I mentioned earlier? By holding investments for more than a year, you automatically qualify for the lower long-term capital gains rates. And by holding your investments for not just 1 year, but for decades, you reduce the number of taxable events. You're only taxed on gains when you actually realize them. That is, when you sell your investments. The last thing you want is to buy individual stocks or to have an investment portfolio that requires many transactions to rebalance or to eliminate poor performers. Executing a buy and hold strategy successfully typically means choosing a specific type of investment. And that brings me to my second strategy. The second strategy is to choose tax-efficient investments. When it comes to taxes, not all investments are created equal. Index funds and ETFs are perfect for taxable accounts because they minimize capital gains distributions. These type of investments pool your money with other investors to buy a diversified portfolio of assets. With just one share, you can own pieces of hundreds or even thousands of companies. This structure means fewer transactions for rebalancing compared to managing individual stocks. Now, ETFs have an extra tax advantage through their in-kind redemption process, which prevents taxable events. Unlike ETFs, mutual funds, even passively managed index funds, sometimes must issue capital gains distributions when investors redeem their shares. So from a tax perspective, ETFs technically hold a slight edge over passively managed index funds like VTSAX or FCROX. But let's not overthink it. Both index funds and ETFs are highly tax-efficient investments and should be your go-to choices for a taxable investment account. The third strategy focuses on reducing dividend taxes. An investment's total return comes from both appreciation and dividends. By minimizing taxes on those dividends, you'll reduce tax drag and effectively boost your after-tax returns. Now, this strategy is really straightforward. When choosing dividend-paying investments, simply look for those that pay qualified dividends. They're taxed at lower long-term capital gains rates rather than your higher ordinary income tax rate. Now, the next strategy is one of my favorite strategies and one that's rarely discussed, and that is harvesting gains in low-income years. Now, here's how it works. When your taxable income is lower than usual, perhaps during a career transition or even semi-retirement, consider selling appreciated investments and immediately buying them back. If you have taxable income under $96,700 in the year 2025, the capital gains realized before exceeding that threshold will be taxed at 0%. And this is taxable income too. So it's an effective adjusted gross income of $126,700 when you include the standard deduction of $30,000. Now, if your income is well below this threshold, it means you could realize tens of thousands of dollars in gains without paying any additional taxes. And by purchasing the investments right away, you reset your cost basis higher, which reduces your potential tax bill in the future. Now, a couple of years ago, we embraced what we call a coast-fi lifestyle, meaning that we are coasting to financial independence. It also means that we drastically reduced our income in order to gain more freedom today. Now, this past year, we had one of our lowest income years of the previous 10 years. This gave us an opportunity to harvest some long-term capital gains while paying no taxes on those gains. This is an exciting opportunity that can give you the confidence to make a major lifestyle change prior to a traditional retirement age. The final strategy lets you offset investment gains by selling other investments at a loss. This is known as tax loss harvesting. This reduces taxes on your gains and can even offset up to $3,000 of ordinary income each year. Now, for buy and hold investors like those following my first strategy, tax loss harvesting opportunities are rare and only make sense in specific situations. For this reason, I'm not going to go into too much detail here, but it is worth noting and can be an effective strategy in the right circumstances. Now, if you use this strategy, be sure to watch out for the wash sale rules. Effectively wait at least 30 days before buying back the same or substantially similar security. Now that I've covered the 5 tax optimization strategies, let's see how they work in practice. I'd like to introduce you to John and Sally, a married couple in their 30s. In 2025, they'll temporarily reduce their income from their usual $120,000 to $50,000. And they'll do this by taking a 7-month mini retirement to travel. They've saved enough in a high interest savings account to fund their adventure. As savvy investors who understand that tax efficiency leads to a larger retirement portfolio and ultimately more freedom, here is their strategy. They follow the buy and hold approach with a portfolio of tax efficient ETFs and index funds. This means they only realize capital gains when they choose to use those investments, avoiding any short-term gains that would be taxed at their ordinary tax bracket. They focus on investments that pay qualified dividends. For the year, they'll receive $10,000 in qualified dividends, all taxed at 0% due to their lower income. And in this year, they notice that their taxable income falls below the 2025 long-term capital gains 0% tax bracket threshold of $96,700. This again is effectively $126,700 with the $30,000 standard deduction for married filing jointly. Taking advantage of this, they sell $100,000 of investments in their taxable brokerage account, realizing $60,000 in long-term capital gains, all of which is taxed at 0%. Since they don't need this money for living expenses, they immediately repurchase the same investments to reset their cost basis. In total, John and Sally receive $70,000 in investment income, combining the $60,000 in capital gains and the $10,000 in qualified dividends, and they receive it completely tax-free. It makes them wonder why they call it a taxable investment account after all, but that's a mystery for another day. Tax optimization is just one piece of a successful investment strategy. Even more crucial is saving enough money to secure your retirement. To discover exactly how much you need to save, check out this video right here. As always, thanks so much for watching and enjoy the journey.